Hi, everyone. We've been getting a lot of questions over the last couple weeks of exactly what went on with Silicon Valley Bank. So we thought we would put this short video together just to kind of answer a few general questions that we've been getting. One is the first is we need to understand how do banks work? What exactly happened with Silicon Valley Bank? And then really the takeaway for everyone who's watching this is just the understanding of what is FDIC insurance and how much are you actually eligible to receive from the banks. So to answer the first question of how do banks work, banks have a few main functions, and they're really simple. The first is they are there to take your deposits, meaning they are there to hold your money. On the flip side of that, they are also there to make loans or lend your money. Those are the primary two functions of a bank. Now, the next thing to understand is what can a bank do with your deposits? Because when you bring money to a bank and you deposit it in your account, technically that is a liability to the bank. They owe you that money that you've deposited. So while they're holding your money, what exactly can they do with those deposits? So they can either lend your money out via loans, or they can actually invest your money, invest those reserves. And at all times, banks need to have enough cash available to meet depositor withdrawals at all times. Because when you go to the bank and you request to take out a certain amount of dollars, if that bank tells you that money is not readily available, there's going to be a little bit of panic. And that's a little bit of what happened with Silicon Valley Bank, and we'll get to that in a little bit. The next question is how do banks make money? And essentially, when banks either make loans or investments, they collect interest in the form of income or investment gains. Any type of income generated by the two activities that they're doing with your deposits, either lending the money out or investing your money, that is the money that they make. Now, at the same time, for you to deposit your money in a bank usually will have to pay you a competitive interest rate for you to keep your money there. So whatever the bank makes via lending your money out or investing your money, and whatever they pay to depositors, the bank gets to keep the difference. That's to cover their overhead, their expenses, and also to book profits for the bank. So that's how they frankly stay in business. So these two activities for them are really important. Now, in the case of Silicon Valley Bank, again, keeping in mind what can a bank do with your deposits, and they need to have enough cash available to meet depositor withdrawals at all times, is let's flash back to 2021 and what was happening. So as everyone remembers, 2021 was the post-pandemic calendar year. Venture capital startups were all really doing well. Money was coming in. Fundraising for these companies was really easy. And Silicon Valley Bank really specialized in the area of working with startups specifically based on the West Coast and technology companies. So they were very popular. And there were very few individual depositors, meaning that it was mostly businesses and companies. And as all of this money was pouring in 2021, and let's take, for example, they had hundreds of billions of dollars coming in deposits, they needed to do something with that money. And frankly, when that money was coming in, they couldn't lend it out fast enough. So they decided that they were going to take, let's say, for example, $100 billion of their cash reserves and purchase 10-year U.S. government bonds at an interest rate of 1.5%. Now, what do we know happened since 2021? Interest rates go up. And if there's anything that we've learned in 2022, or any investors learned in 2022, that when interest rates go up and they go up really quickly, what happens to bonds? Their bond prices go down, right? Because if you flash forward to 2023, Silicon Valley Bank now has 8-year U.S. government bonds paying that 1.5% because there's 2 years that have already gone into that 10-year term. But if they sold it today, the value would maybe only be about $75 billion. And the reason for that is, flash forward to 2023, an 8-year bond today may be paying close to 4%. So you as an investor is not going to pay $100 billion for those same loans. They're going to be marked down. And that's what happened to Silicon Valley Bank. Now, what is also happening during this time period is that depositors started to realize and say, wait a second, I'm not getting a lot of money or interest keeping all of my reserves at Silicon Valley Bank, and I have millions and millions of dollars that I fundraised over the last couple of years, and I can go out and buy 30, 60, or 90-day US Treasury bonds that are paying me well over 4%. And depositors went to their bank, started pulling out their cash, moving it over to brokerage accounts, purchasing those treasuries. And at the same time, what has happened since 2021, a lot of these startups have burned through a lot of cash. Growth is slowed down, fundraising is slowed down, and they need to meet payrolls and they need to meet their overhead costs. So what was at the time in 2021, Silicon Valley Bank thinking they have a lot of stable depositor dollars became very unstable in 2023. And as soon as depositors realize they can get more interest in short-term US Treasury bonds, they start withdrawing their money. The word gets out the bank may not be able to meet deposit withdrawal requests, and the reason for that is because they have to disclose what the reserves they have on their financial reporting. So again, when you start digging under the hood and word gets out that there's a chance that they're going to be struggling in meeting depositor needs, and specifically what happened with Silicon Valley is they realized they couldn't just sell these at a markdown. So they went out and said, okay, well, I need to make up the difference of this $25 billion. I'm going to do it via raising stock or raising debt. And that plan quickly got shut down, and panic ensued over that weekend, and the confidence in the bank breaks, which again, you now have a bank run, meaning that everyone loses confidence in that bank, and they don't know if their money is going to be there. So everyone tries to pull it out all at once, which is obviously what is going to create this issue. So the FDIC stepped in that weekend, and the Federal Reserve, and guaranteed all bank depositors. And the reason that they did that is because of the word confidence, is that you do not want any type of smaller bank to have any type of depositors lose confidence in not being able to get access to their money. So that kind of hopefully calmed a lot of that down. Now, Signature Bank also had another issue, and some other banks are on the radar. However, the FDIC did come in and take the necessary steps to make sure that those depositors would have access to their funds immediately. So the takeaway from this is FDIC insurance. It's really important to pay attention to. Now, for the far majority of for the far majority of folks, frankly, it's rare that you're going to come up against this because no one is carrying this much amount of cash in their banks. But if you are, we just wanted to bring it to everyone's attention that if you are a single individual, you can have up to $250,000 of total FDIC insurance coverage at any individual bank. Now, if you are a married couple, you can actually have up to $1 million of FDIC insurance. And the reason for that is because each spouse can have $250,000 deposited into each individual account, which is a unique registration, and as well as $500,000 in a joint account. So if you put all of that together, if you had $1 million at XYZ Bank, if you set it up this way where each individual account had $250,000 and a joint account had $500,000, you'd actually be fully insured. For businesses, at any individual bank, you have up to $250,000 of FDIC insurance. So when looking ahead at the, options of is there a way to get more? I have more cash than the traditional FDIC insurance. Is there a way for me to get more? And there are a lot of fintech solutions that are popping up that essentially partner with banks to expand on the amount of FDIC insurance that they can provide. So for example, as everyone knows, we talk about Flourish Bank, or Flourish Cash, excuse me. And what Flourish Cash does is they partner with program banks, which can provide additional FDIC insurance. And they can also negotiate higher interest rates. So at Flourish Cash, for example, a single depositor can have up to $1.5 million of FDIC insurance. A couple can have up to $6 million of FDIC insurance, again, by setting up 2 individual accounts for each depositor plus a joint account. A business can have up to $1.5 million. And I want to call out specifically this last part, the businesses, because $250,000 for most businesses is not a lot of FDIC insurance to have at a single bank. And what we're finding is, and frankly, we do this for ourselves at Highland, is leveraging one of these platforms like Flourish to be able to have any overflow of cash outside of the operating bank or the operating cash that you use for your business to overflow into something like Flourish, just to make sure that the FDIC insurance coverage is there at all times. So this is just a quick summary and overview of the takeaways of what's happened over the last couple weeks. We'd love your feedback on this video, so feel free to share. Thank you.